Hello, and welcome to our continued discussion of PepsiCo's 2014 annual report. This video will focus on its liabilities disclosure and times interest earned ratio. So we're going to look deeper within PepsiCo's 2014 annual report. For more information about its liabilities, you'll need to be able to access the balance sheet on page 71, the footnotes 9, 14, and 2, as well as management's discussion and analysis. If we look at the consolidated balance sheet, I've taken an excerpt of the liability section. You'll note that there are short-term interest-bearing obligations and long-term interest-bearing obligations, meaning debt that there is interest on. We will look at these in footnote 9. There are also summary information about accounts payable and other current liabilities. Accounts payable and other current liabilities are about 20%, a little over 20% of total liabilities. So much of it is these interest-bearing obligations, short-term and long-term. There are other liabilities which there isn't a lot of detail about, including the unfunded portion of pension liabilities and the unfunded proportion of retiree medical health benefits promised. And you notice that after liabilities they have commitments and contingencies. I thought I would describe a little bit more about this by looking at footnote 2. So a company as large as PepsiCo with as many products are subject to various claims related to lawsuits, taxes, and environmental matters, whether they have to do environmental remediation because of their manufacturing, and they will recognize a liability for it when the loss is probable and estimable. They give a little bit further information on commitments that they have that are not coming due yet in footnote 9. If we want to look at the debt obligations, remember the short-term obligations of $5 billion and the long-term obligations of $23.8 billion, you get details about the interest rate on the debts. So whether it's the current portion of long-term debt, let's say it was a 5-year note payable and it's year 4. Commercial paper is very short-term borrowing and has a very low interest rate, 0.1%, and other borrowing, some of which have quite a high rate, like 17.7% contractual interest rate. So what is given is when they are due and the contractual interest rate. Altogether, this interest-bearing debt makes up more than half of the liabilities. In addition to debt, sometimes there are commitments to not only pay the principal of debt today, but payments on interest, payments on leases. If you have a rent, if you're committing to making your rent and you've signed a lease that has more than 1 year to it. Purchasing and marketing commitments. Note 14 contains information, finally, in addition to other supplemental financial information, about the total amounts of accounts payable, usually short-term obligations to suppliers that do not charge interest. This accrued marketplace spending when we pay grocery stores to display our products. Compensation and benefits are wages payable as well as other benefits in addition to wages that we pay in payroll taxes. Dividends payable, and finally other current liabilities. The total of accounts payable and other current liabilities is $13 billion. So the footnotes go into a bit more detail than the balance sheet in describing debt obligations and other liabilities. If we want to analyze liabilities with ratios, one ratio that we can use is times interest earned. which is net income from the income statement plus interest expense from the income statement plus tax expense, that sum divided by interest expense. In essence, how much pre-tax, pre-interest income we have to cover the interest expense that we pay this year, or that we incur this year. So with PepsiCo, net income is 2014 is $6.5 billion, tax expense is $2.2 billion, and interest expense is $909 million. Therefore, it has a lot of pre-tax, pre-interest income relative to a relatively small amount of interest expense. It has 10.6 times as much pre-tax, pre-interest income, and that's pretty comfortable compared to its interest expense. It had a slightly better times interest earn ratio. In 2013, it had a ratio of 10.7 times instead of 10.6 times. So even though it was slightly less solvent in 2014, in both years, I think that the creditors, the people that it owes money to, indicates that there is more than enough interest coverage to satisfy the people that lend the money. If you remember, for solvency ratios, they measure the ability of the company to survive over a long period of time to repay long-term obligations. We've already calculated in a prior video the debt to total assets ratio using the classified balance sheet. And when we did so, we said that for every dollar of assets, PepsiCo uses other people's money or obligations it pays to people who aren't owners to finance its assets. It has 75 cents of every asset is financed by debt, whether it's interest-bearing or just accounts payable, and this was more than it was in 2013. So the debt to assets ratio, or every dollar of assets, was only financed with 69 cents of debt in 2013. PepsiCo is less solvent because more debt implies risk. Please feel free to review this presentation before looking at liabilities for your company and calculating its timed interest earn ratio. The discussion will help you compare your company to another in a different industry. Good luck, and get started, Jaspers.